Money Mondays with Chad Eddy.
Episode 7, Debt Traps. Why credit cards, lines of credit, and overdraft protection want to own you. All right, welcome back to Money Mondays. I'm Chad Eddy, and today we're talking about something that might sting a little. Debt, or as I like to call it, the velvet handcuffs of the financial world. It looks soft and comfy and even helpful at first until you realize that you can't take it off and now you're financially handcuffed to a monthly payment for the next 5 years. We'll cover credit cards, lines of credit, payday loans, overdraft protection, and why debt companies love you more when you're struggling. We're also going to talk about why you don't need a credit score as much as people say that you do, and why you should think twice when someone at Walmart or Canadian Tire offers you a free credit card. Spoiler alert, they're not your financial fairy godmother. They're more like a financial vampire. Looks friendly until it drains your wallet dry. Now, debt isn't new. Ancient Mesopotamians were borrowing grain thousands of years ago. The Romans borrowed money to fund wars, and let's just say it didn't always end well. Fast forward to the 20th century, and credit became more personal. Credit cards appeared in the 1950s with the Diners Club card. It sounds classy, right? But by the 1970s, credit companies realized something. The more people borrowed and the longer they took to pay it back, the more profit the companies made. And that's when the game really started. Debt became a business model, not a convenience. Companies started offering credit cards like candy, and today they hand them out like flyers at a music festival, except these flyers can trap you in a financial mosh pit. Now let's be honest. Debt is seductive. It lets you buy things that you can't afford right now. Vacation, sure. New TV, why not? But here's the catch. Every dollar you borrow comes with a price tag, and that price tag is called interest. Credit cards are the worst offenders. The average interest rate is around 19.99%, sometimes higher. That means that if you spend $1,000 and only make the minimum payments, it could take years to pay off and cost you hundreds of extra dollars in interest. Suddenly, that $1,000 TV isn't such a great deal. Okay, let's talk interest rates. The term you hear most is APR, annual percentage rate. This is the cost of borrowing money over a year, including fees. But not all interest rates are created equal. There's something called the prime rate, which is the interest rates that banks charge their most trustworthy customers, usually around 6% these days. Now, credit card companies could charge you close to that rate, but where's the profit in that? So they crank it up to 19, 25, or even 29% because they know many people won't pay off their balance in full. Lines of credit usually have lower rates, often a few points above prime, but don't be fooled. Borrowing is still borrowing, and overdraft protection, it might save you from a declined payment, but at what cost? Overdraft fees can be $5 or more each time plus interest. It's like paying somebody to kick you while you're down. Now, if credit cards are the velvet handcuffs, payday loans are the financial bear trap. They lure you in with promises of quick cash, but their interest rates are sometimes 300% or more. 300%. If you think that's a good deal, I have a bridge in Vancouver to sell you. Here's the worst part. Payday lenders know their customers are desperate. They don't expect you to pay back the loan right away. They count on you rolling it over, racking up fees, and sinking deeper into debt. Do you know why a lot of payday loans are in the lowest income bracket areas in town? That's why. Now let's talk about something controversial. You don't need a credit score as much as you think you do. I know. Everybody says that you need a high credit score to get a mortgage or a car loan, but let's break it down. A credit score is just a number that tells lenders how good you are at borrowing money. It doesn't measure your wealth, your savings, or your financial health. You could have zero debt and a solid savings account and still have a low credit score. So don't get sucked into borrowing just to boost your score. Have you ever been offered a credit card at Walmart, Canadian Tire, or your local mall? They make it sound like they're doing you a favor. Get 10% off your purchase today. But here's the deal. These companies don't make money when you pay your bill in full. They make money when you don't. Every month you carry a balance, they're cashing in. And don't get me started on credit card booths at colleges. They prey on students who are new to money management, hoping they'll overspend and fall into debt before they even graduate. It's not the person handing you the flyer who's the villain, it's the system behind them. It's designed to profit off of your mistakes. So how do you avoid falling into these traps? Simple. Use debt carefully and intentionally. If you use a credit card, pay the full balance every month to avoid interest. Use a line of credit only for emergencies or strategic investments. And as for payday loans, just don't. Seriously, sell something on Facebook Marketplace before you even step foot in one of those. Now with this episode, open your eyes, hit that like button, subscribe, and share this video with someone else who needs to hear it. And don't forget to download my free ebook, Automate Your Budget for Canadians. You'll find the link in the description below. Follow me on social media for more tips and behind-the-scenes content. On Instagram, you can follow me at Chad Eddy Money Mindset. Facebook at Chad Eddy. Next week, we're going to focus on setting up your financial future, covering RRSPs, TFSAs, the difference between them, and other tax shelters and investments. Don't miss it.